It's Brian Preston, the money guy.
So this is wealth habits for 30-year-olds, but the first thing we have to do is make sure that that mindset is set for the decade. What should you be doing in that 30 to 40 mark? So here's where we are. At a minimum, when you enter the 30s, you should be saving 10% of your income.
So 20s, you start somewhere. 30s, you really need to be at least getting to that 10%.
Yeah, I didn't say
number.
just because the 20s, I told you, oh, it's all right. You come out of college or you just start getting into your profession and you're saving at least 3%. That's okay because I get it. There's some scarcity of income at that point. By the time you're in your 30s, though, even if there's a scarcity of income, you've got to start figuring out how you're going to get to 15 to 20% of your money working for you. That's because remember, that's your stretch goal. Is you want to have 15 to 20% as a baseline savings goal of your gross income with hopefully an eye towards 25% to be a hyper saver. So at a minimum, when you enter the 30s, you want to have 10%. And very quickly, you want to have that 15 to 20% reached by 35 years of age.
Yep,
I think if you have not done it by 35 years of age, you might be a touch behind. So let's talk about valuable wealth building habits for my 30-year-olds.
Okay.
And these are good too. Have you found your mentor or person that's going to challenge you?
Yeah, that's a beautiful one. You know, I think that what's so interesting that we recognize is that, you know, coaching, it's a huge industry and people think about, oh, when I reach a certain level of success, I need to go hire a coach to help me. What I think is beautiful is when we're young, there are older people, wiser people who are willing to invest in you, willing to pour into you. You're basically getting that coaching and oftentimes it's for free because it's someone you work with or it's a family member, it's someone in your community. If you haven't found and connected with a person who is living the life at their age that you would like to be living and you're not kind of drinking from their knowledge, you're really missing a huge opportunity.
And here's a turbocharger because, you know, when I was talking about 20-year-olds, we talked about have a gracious heart where you say thank you a ton. One of the things, once you find that mentor, make sure that you love back up on them, telling them, hey, thank you for sharing so that they want to continue to open that fountain up and share as much knowledge as possible. Because they're going to give you the feedback. They're going to give you the stretch goals and hopefully make you the better version of yourself. So find that mentor as soon as possible. The next, wealth habit for my 30-year-olds is have a plan. This came out of my collaborative discussion with, everybody here in the office, is have a plan on how you're going, what is your family situation going to look like? If you're going to have kids, how are you going to raise the kids? And how many kids are you going to have? This stuff, there are so many studies on how expensive having children are that if you don't at least have a plan or attempted to have structure on this, I think you're missing out on. And then I put some sub notes on this. Is think about the example you're setting. My wife was out of town all weekend. She went down to visit her mother down in Georgia, and then she went down for a birthday party. So it was me and the girls. And I was doing something in the garage, and I dropped my phone or I dropped something, and it was one of those things that just wasn't supposed to happen. So I said a 4-letter word. And my 8-year-old was being my side helper. She really convicted me. That she
let you know you said a word that Daddy shouldn't have said,
and
right?
it shocked me. I'll be honest with you. It really shocked me on how scolding she was about it. And so, and this is just one thing. Because it comes up all the time where your children are paying attention. So think about the financial habits that you're paying it forward with them. It's not just about cussing around your kids. It's also making sure you're setting a good example for them. But I'll look at you because I pick on you. You haven't done it yet, but we do have discussion. If you are considering private versus the public school with your kids, make sure you have a reasoning for it. I've shared, my special needs child is in a private school, but our oldest child is in the public schools because we live in a really good school district. That's a discussion you need to have because if you are paying for the private school, K through 12, at least have a plan for why. Understand why. Because, we've talked about if it's a FOMO or keeping up with the Joneses, that's not a healthy reason for doing that. So have an understanding of that.
And not only have an understanding of why when you make those sort of decisions, but understand what the long-term impact of those are. Because you kind of need to weigh, maybe you had this idea about building your dream house in your 40s, but then you also are thinking about sending your kids to private school, and maybe those are competing goals. And so it's important to have those conversations early on so you're not setting yourself up for frustration and anger and upsetness later on.
The last 2 points I had on the wealth habit of at least having a plan about children and what your family structure will look like is, if you do have children, instill that builder's mindset from an early age. You heard me talk about, if you go back and listen to it, if you didn't hear it, but when I was talking about 20-year-olds, you're coming out of 20 years of more than likely, for most of the population, people were taking care of you.
Sure.
So I would challenge my 30-somethings who have families to try to instill a builder's mindset to create independence in your children already. I think that could be very helpful for them in the future as well. And then last thing is just college funding. We've done shows on college funding. That obviously needs to be something that you have at least a thought towards to know what that means for you and your family. So let's move on to the third wealth habit, is make sure at this point that your debt or any debt in this stage is potentially productive debt. Now, you're like productive debt. Because we've done the whole zombie debt shows. We've done, and look, even productive debt is debt.
Yeah.
I mean, debt is a 4-letter word. I mean, let's face it, it really is. And there's so many people that it's one of those things that, and I hate that it's polarizing because I know that a lot of our Money Guy family, they're split on the whole credit cards, and we've done credit card episodes, but I get it. I'm with you. Debt is a 4-letter word, because it's in battle with the term of financial independence, because it is an obligation, and by the sheer fact of design, obligation is in conflict with independence.
And I think what's really interesting is in your 20s, debt kind of has a little bit of control on you out of necessity. Yeah. If you need to buy a new car, you might have to finance it. Obviously, when you buy a house, you need someone to likely let you borrow money for that. In your 30s, you really need to be having that conversation around, am I in control of my debt, or is my debt in control of me? And one of those is the right answer, and one of those is the wrong answer.
So let's actually put in perspective of what debt we're talking about that could be classified as productive debt. Mortgage debt, I mean, more than likely you're not paying 100% for your house, so you are going to have mortgage debt. You need to be tying down and closing up the student loans. I think that you need to be winding. Now, I recognize some of you out there in the audience are from the medical field. You're like, guys, I just got through my residency. I'm not done with the multiple six figures of debt. I get that. I mean, you're a unique case, but
you should have a plan in place for it.
You need to have a plan for it. You don't need to be carrying any credit card debt on over a month-to-month basis. I'm not saying cut off the credit cards, but if you're not paying off your debt monthly, that's a problem. You might need to go back and reevaluate. Do you even need to have credit card debt if you can't pay it off monthly? And then because this is what society is going to tell you, don't have a payment focus.
Oh, this is such a big one.
Payment focus is what will lead you to have a brand new car in your driveway, an RV in the backyard with some jet skis on a trailer right behind it, and not a dime in the bank.
Because you can afford the payment.
Yeah, because everything's $200 a month.
That's right.
I mean, that is the truth of the matter, is don't have a payment focus. Every time you go take down debt, know what the dollar amount is. Don't let them trick you into paying attention. Is it $200 a month? Because that $200 a month could be because you're paying for it for 10 years. I mean, you guys know, I've made it no secret, excited about the Tesla that's coming in, the Model 3, the more affordable Tesla. I stalk the Tesla forum, and it cracked me up. I didn't post because I don't know. I just didn't want to post, but there was a whole conversation about people financing for 84 months or considering financing 84 months because they really wanted to get into a Tesla. Guys, I know you want to be part of the revolution. It's cool having a car that's fast and all the other stuff. But if you are having to finance a Tesla for 84 months, don't buy the Tesla. And I love Tesla, but don't go buy a Tesla.
Let me make a suggestion. We did a show a number of years ago called Financial Decisions You Hope Your Friends Make. If you're someone who's thinking you might have to go finance a Tesla for 84 months, just have a friend who's I've got a buddy who's getting a Tesla in like the next week, and it's saving me a lot of money. So something to think about.
Touche. It will not be financed for 84 months. Remember and I've talked about this on the Keeping Up with the Joneses show. Go listen to it if you haven't heard it. Pay off your car loans in 3 years. I don't care if you finance it for 48 months because it's the same interest rate, or 60 months, but it better be paid off in 3 years if you want to have a healthy mindset. So, and that leads to, that's a great segue. I didn't mean to do it. I mean, maybe it's subconscious, but beware of FOMO or fear of missing out, and the comparison trap of trying to keep up with the Joneses.
And don't you feel like it gets bigger and worse in the 30s? I mean, it's bad in the 20s when everybody's kind of coming out and competing, but it's almost a little more juvenile. And then in your 30s, I think it really gets.
I think it's by every decade.
Yeah,
I think it's by every decade. Unfortunately, the problem is that in your 20s, I think you have your own internal self-coping mechanism, because you know when somebody's bragging about how good things are going. Like, yeah, but how good could he really be?
Right.
We've only been out of school for 5 years. It does in your 30s and 40s, because people are starting to get traction in their careers or things are starting to happen. I think that the comparison does kick in. The intensity does. But it's always going to be there.
Sure.
I will tell you. And that's why you just need to figure out who you are as soon as possible, so you feel very comfortable and don't get into these competitions. And then here's one, and this sounds somewhat familiar, but it's in a different form. You know, we've talked about, if you go back and listen to what I told the 20-year-olds, I talked about risk is something you need to look at, but it might be an opportunity for you.
That's right.
I think for 30-year-olds, risk is completely different. Now it's something that needs to be accounted for and locked down. Bo, what do I mean? Because you're kind of in this stage.
So a big thing you need to think about are the types of insurance protection that you have in place. You know, if you have a spouse or if you have young children or someone dependent upon you, you need life insurance. If you have someone who's dependent upon your income, you probably need some disability insurance. If you do have, unique things going on like a spouse and like children, you really need to have wills in place that suggest what happens to your stuff and what happens to your people. Because you want to be able to make those decisions while you can on this side of this life. And then another one that often gets overlooked is if you start to own property, you do have cars and homes and income earning potential and boats and everything. You might need to go look at umbrella insurance, because you just want to make sure the unknowable out there isn't the thing that completely wreaks havoc on your plan.
So make sure you have the risk accounted for and locked down and a plan for it. And as Bo shared, just in quick summary, if you do have people counting on your income, at this stage, term life insurance is so cheap. I mean, because you're probably relatively very healthy. So you can get 10 times your income for pennies on the dollar. I mean, so go look at what term insurance is. I mean, I think that would be a good thing.
So here's a spot check for the 30. So let's assume that you're a 35-year-old. And again, from the Bureau of Labor Statistics, on the lower end, a 35-year-old on average makes about $39,416 a year. If you're going to begin saving, and you're going to save until the time you get to 65, then we're going to assume a 10% rate of return. And we are going to say that you got to where you needed to be and you're saving 15% of your pay. If you start saving 15% at 35, earning 10% per year, by the time you get to age 65, you will have over $1.1 million in the bank.
And if you just so you don't, in case you don't have a calculator, that's $492 a month. That's close to, so it's a little under $500 a month. So a 35-year-old needs to be saving about $500 a month, and they'll have $1.1 million.
I just think that's an important thing to mention. So a 35-year-old who saves $500 a month will get to 1.1. Do you remember what a 25-year-old who was saving $500 a month gets to?
It was $3 million.
It's $3 million. That's how important those early dollars can be.
So do this for me, because I remember on the segment when we were talking about 20-year-olds, 92% of that 1.1 million, well, the 1 million, the 800,000 for
92% was growth.
92% came from growth. What is it for the 35-year-old?
It's still pretty astounding. It's 84%. So of that $1.1 million, 84% of that is just your money working for you.
So there was about an 8% drop off on the army of dollar bills. Still super strong. I mean, you got a bunch of, Sly Stallone and Arnold Schwarzeneggers on the front lines, but it's the Expendables, Sly Stallone. No, maybe not even Expendables. It's just maybe Rambo 3 or Rambo 2 versus, Rocky from the 20s, because it's just much more productive if you can start in your 20s. But 30-year-olds, you still have tremendous growth potential. Bo, take it a step further, though. What if they want to have $1 million, $2 million, $3 million?
So here's your ABC 1, 2, 3 savings benchmarks. If you want to have $1 million starting at 35, you need to save about $442 a month. If you want to get to $2 million by age 65, you want to save $885 a month. And then if you do want to have that $3 million number starting at age 35, you will need to save $1,327 per month.
Yeah, I mean, that's still, because a lot of this, remember, you probably got an employer match.
Right.
You're getting money from that employer who's adding to this number. So that's conceivable.
It's still inside reach,
I think it
for
definitely is something that could do if you want to be have $3 million. I almost made your mistake and said $3 millionaire.
If you want to be a $3 millionaire, that's how you do it.
Awesome tips for our 30-year-olds.